Welcome to a new smart money video on dollar cost averaging. Today we are going to look at dollar cost averaging, when you should use it, when you should not use it. What is the most profitable form of dollar cost averaging? It is critical for anyone getting into investing or who is investing to understand this strategy, because a simple buy every month, put $500 into the market. And there are a number of examples which show us between 2000 and 2009, if you did this every single month for that period of time, you would have made 6% in total. In other words, less than a 1% return from the S&P 500. Now that should shock you. So what's coming up is going to help you to make an informed decision and to give you some options around what to do with dollar cost averaging and how to invest. Subscribe to the channel to get videos on personal growth, finance, investing, and business. Quick disclaimer, I'm not a financial advisor. I am some guy on YouTube. This video's purpose is to expand your thoughts and the number of options that you have. It is not to tell you what to do. A summary of what we're going to cover today. We are going to look at what is dollar cost averaging, some performance statistics around dollar cost averaging versus lump sum investing, which is better, as well as the variations on dollar cost averaging and when to apply them. Which market should you apply each form of dollar cost averaging to maximize your returns? So simply put, dollar cost averaging is a way of getting an investment into certain asset class. Let's use the stock market as an example. I have $100,000 and I want to invest in the stock market. Now, some say in order to reduce your risk, what you do is, instead of taking 100,000 and buying shares right away, you buy shares over 12 months. So this month I will buy 10,000 worth of shares. Next month, another 10,000. The month after, another 10, until all my 100,000 is invested into the market. The opposite of this is a lump sum investment. And this is where you take $100,000 and you buy everything on the same day. You can use dollar cost averaging as per this example where you have a lump sum investment. You can also use it for changing proportions in your portfolio. Perhaps you have 70% in stocks and 30% in bonds, and you want to make it 30% in stocks and 70% in bonds. Well, in that case, you can use dollar cost averaging to shift the proportions of your portfolio from one asset class to another. What dollar cost averaging is not your monthly contribution towards your 401k or your pension fund or your retirement annuity. That is not dollar cost averaging. It's supposed to be about a lump sum that you're moving from one place to another, from cash into markets or from one asset class to another. So the 401k is just investing over time. That's not dollar cost averaging. To summarize, what we've covered so far is what is dollar cost averaging. What is coming up is the performance statistics of dollar cost averaging versus lump sums, and then we will look at the different variations of dollar cost averaging and which to apply in each market. Please hit that like button and remember to subscribe to the channel. Gerstein Fisher did an interesting study, and we're going to use it for some statistics. Vanguard also ran a similar one, and the statistics were quite close, so I chose Gerstein Fisher's study. And basically, they took scenarios from 1926 all the way through until December 2010. And they looked at a strategy of dollar cost averaging over the course of a year, so 12 equal investments over a year versus a lump sum. And they calculated which one performed best, how many times did they perform better, did one strategy perform better than the other, and was that a significant performance difference or not? And here is the interesting thing with the statistics. Lump sum investing outperformed dollar cost averaging 71% of the time. Now that is significant. In other words, if you randomly invested your lump sum anywhere since 1926, you would have outperformed taking a year to invest that amount of money in 12 equal lump sums. 7 out of 10 times. So the probability is that 3 out of 10 times dollar cost averaging would have been better, but 7 out of 10 times lump sum investing is better. Now, the interesting thing is that when dollar cost averaging outperforms lump sum investing, it outperforms it by less on average than when lump sum investing outperforms dollar cost averaging. So in other words, when you do lump sum investing, the chances are in your favor that you will do well, but we're going to actually share when it is best to do it and a optimization way of maximizing your returns so that you can not get a 7 out of 10 chance with a lump sum or a 3 out of 10 chance with a dollar cost averaging. But what's going to come up is the variations and how to really improve your chances of success and of maximizing your return. Another study which I found on ResearchGate, and I will link in the description, also showed that lump sum investing outperforms dollar cost averaging in a number of different asset classes, markets such as emerging markets, established markets, the S&P, and so on. The conclusion of the author from this paper was that temporal or time-based investing, so dollar cost average, you're using time, over time you're investing, temporal investing does not work better as a strategy to reduce risk. Rather, it is the well-known diversification across asset classes which reduces the risk associated with market volatility. To summarize what we've looked at so far is that we've defined what dollar cost averaging is, then moved on to some statistics around it and the performance of dollar cost averaging versus lump sum investing. We are now going to look at some variations so that you may know which form of dollar cost averaging should you apply in a crash, or in a recession, in a bear market, or in a bull market. Which is better? Please remember to press that like button and get the YouTube algorithm to promote this video. Now, there are 3 types of dollar cost averaging. There is the dollar cost averaging, which is equal amounts over a period of time. The second one is value-based dollar cost averaging. And what that means is, when you buy some shares, say you buy them at $10, and next month the price is $9, you buy even more. So if I bought $10,000 out of my $100,000, the next month I see the price is down, I buy $20,000. In other words, I increase the amount that I buy per period of time. And if you picture this, it's like a bear market where the prices are decreasing over time. The more the price decreases, the more quickly I buy. The third method is momentum-based dollar cost averaging. And this is the complete opposite of value-based dollar cost averaging. And in this case, what you do is when you see losses, you buy less and less. And when you see the market turn, so if the price was $10, I buy 10,000 worth. The price is now $9, I buy 5,000 worth. The price is $7, I buy 3,000 worth. Now the price goes up to 9,000. Well, I buy $10,000. The price goes up to $11. Well, I buy $20,000. So in other words, as the market is decreasing and the momentum, if you like, is less and less, you buy less and less. As the price is increasing and the momentum of this price is increasing, you buy more and more until your full 100,000 has been invested. So now what do the statistics say? Which one is better? Well, actually it's interesting. On average, across the entire time and history of the stock market, value-based, in other words, buying more when prices go down, buying less when prices go up, performs worse than just a equal portion dollar cost averaging or the normal dollar cost averaging. And that performs worse than momentum-based dollar cost averaging. Now here's the interesting thing, and this is the final tip and bit of education I would like to share in the video. Which one do you use in a market crash? Well, momentum-based dollar cost averaging performs the best. In other words, as the market's crashing, you buy, and it continues to crash, you buy less, and it continues to crash, you buy less. But as the market turns, you buy more and more and more until your full position is done. However, what about a bull market that is in full swing? Which one is best? Well, then it is the value-based dollar cost averaging that will be best way for you to get your investment into the market. Because this means as price goes up, you buy less and less. And when price comes down in the bull market, which is a correction, you're then taking advantage of it and you're buying into that weakness. I created a video for investment for beginners and I will link it up on the screen now. Please check that out. As well as remember to subscribe to the channel and share this video with someone, because together we can create an abundance.